Hello, this is Jide Adilowo from Smart Currency Traders. We are into Forex, binary option, and cryptocurrency trading. I have been around Forex. I've been trading Forex since 2005. I have the privilege of knowing some in and out of the trade. In this training, I will be passing you through Forex trading. Let me first give you an overview of what I will be teaching you. Forex overview. Forex is basically divided into three. We have the Forex basics, we have the Forex technical analysis, we have the Forex fundamental analysis, which is also called Forex news. Under Forex basics, I will be talking about what is Forex, currency pairs, pips, leverage, lot size, bid and ask, spread, margin, stop loss, take profit, pending orders, and trading session. The second aspect of Forex is Forex technical analysis. Forex technical analysis is all about how price move, talking about the movement of the price. If price has moved in certain way in the past, it's likely to move in that same way if all the conditions that made it move in the past is fulfilled. So Forex technical talk about how the market move, that is the movement of the market. So we'll be talking about under this, we'll be talking about the price action, charting, trend line, price patterns, support and resistance, etc. Under this, there is need for you to master this technical analysis so that you can be able to use your strategy to trade the market. But there are also trading tools that made it a lot easier for you to trade it. You don't need to pass through the stress of mastering the skill, because there is need for you to master a skill in order to be able to trade the forex market and make profits. But we have what we call the forex tools, which forex trading tools, which are the forex robots, forex custom indicators that you can really use and be able to trade the market even when you have not had enough knowledge or master any trading skill. So these robot and indicators have been proven to be working and be consistent. They have high level of accuracy. They have been used and their accuracy can be 75%, 85%, 90%. There are even some that are even like 95%. So you might not even need too much of, because if it will take you like 6 months, 1 year to master and practice a strategy, forex strategy that you can be using to constantly make profits. But these have been done in a form of a robot and a custom indicator that will just give you direction on what to do. Some will just tell you buy, sell, and you just follow the instruction. And before you can start using all of this robot or indicator, you ensure that you have one that the accuracy and the consistency have been ascertained. And if you need some of these things, you can get across to us. We have some that are really working, that if you just get to know the forex basis, you can just acquire and get these tools, and you can just be trading and be making profits almost immediately. The third aspect of forex is the forex fundamental analysis. Forex fundamental analysis is all about why price or market move. What moved the market? We will be looking at the economic indicators and the monetary policies. Under the economic indicator, we'll be looking at growth indicator, inflation indicator, employment indicator, housing indicator, business survey indicator. Forex fundamental analysis generally deal with why, what are those things, what happened that moved the market. Like now, if the gross domestic product GDP of US is being announced, at that moment, if it favors the currency, the market will move in that direction. So these are things that really move the market. So when these things happen, the market moved. So fundamental analysis is just you analyzing the market at this time and know what to do in order to maximize what has just happened. This is just the overview of Forex. Now we'll be looking into detail the Forex basis. We'll be starting from what is Forex. I'll be going through this presentation even to go detail to really give you a full understanding of Forex basis and everything you need to know about the Forex basis. The currency market, also known as Forex, foreign exchange, that is FOR for foreign and EX for exchange, is the world most traded market with an average turnover in excess of $4 trillion a day. That is over $4 trillion change hand every day, bigger than any stock worldwide. So Forex is extremely big and a lot of exchange is being done daily. This buying of one currency and selling of another pairs the two currencies together, creating what is called a currency pair. Is the comparison of one currency's value against the other currency in a pair that generates the potential to make money. In Forex, we talk about currency pair. That is one currency pair with another one. Movement of this currency is what really generates money in Forex. It's the comparison of the two currencies in the pair that we are trading. One will get stronger in comparison to the other, and this change the exchange rate between the two currencies. So these two currencies, one will be getting stronger at the time while the other one will be weak. So when one is stable at the time and one is getting stronger, then the market will move. It is the comparison of these two currencies we are trading in Forex. Currency value rise, appreciate, and fall, depreciate against each other due to a number of factors including the economy and geopolitics. So demand and supply in the markets everywhere in the world make this currency to appreciate and depreciate, and that's exactly what we are trading for Forex. Unlike most financial markets, the OTC, over the counter Forex market, has no physical location or central exchange and trades 24 hours a day through a global network of businesses, banks, and individuals. In Forex, we're talking about trading everywhere. There is no one place that Forex is being traded. It's a demand and supply and connection of businesses and banks all over the world that really move the market, and that's what we are trading in Forex. This means that currency prices are constantly fluctuating in value against each other, offering multiple trading opportunities. So when anything happens to US dollar, maybe you are having US dollar with Japanese yen, anything happen to negative happen to US dollar, definitely the Japanese yen will be appreciated. So those two currency pair, so while they appear together, the value will be fluctuating or going up and down depending on what is happening to each of the currency pair. Currencies trade on an open market, just like stock, bond, computers, cars, and many other goods and services. The currency value fluctuates as supply and demand fluctuate, just like any other product. So as there are supply and demand happening to any country that the currency is being traded in the forex market, definitely the value of the currency will be fluctuating, and the movement of this value is what is being traded in forex. An increase in supply or or decrease in demand for a currency can cause the value of the currency to fall. Immediately there is an increase or there is a decrease in an increase in supply and a decrease in demand will affect the price, will affect the value of the currency. The same thing happen. A decrease in supply or an increase in demand for a currency can cause the value of the currency to rise. If there are more, if you decrease the price, you decrease the supply of a thing, definitely there will be appreciation of the price, which is the value of the currency. So that is exactly what is going on. So supply and demand of this currency or product and services that is rendered with this currency have effect on the value of this currency per time, which also have the effect on the currency pair that is paired with this currency. So at any particular time, any other currency paired with this currency will be fluctuating in value. A big benefit of forex trading is that you can buy or sell any currency pair at any time. This is a major plus that forex has compared to stock and every other thing. Whether the market is buoyant, whether there is recession, you can always buy or sell. If there is recession and a currency is being affected, the currency will be getting weaker. What you just need to do is to sell. At that time, you're making money, either buying or selling. No matter the condition of the market, you are making money in forex. Unlike stock, when the value of a thing, the stock is going down, everybody loses money. No, in forex, what you just do is to sell. So forex, you make money, either market is good or market is bad. Yes, we want to be talking about the major currency that have been traded in forex market. Some of the most common traded currency are Eurozone, GBP, which is called Great Britain pounds. Then we have AUD, Australian dollar, NZD, New Zealand. So all of these are the what we call the most traded currency pair. They are the major currency pair that you need to know about. Let's now go and want to be talking about pairs and pips. In my introduction, I've told you about we have what we call currency pair and we have what we call pips. What are they saying in detail? In forex trading, all currencies are quoted in pairs. That is, you can't just go to forex market and say you want to trade a currency alone. Before you in the forex market, that currency must be compared with that currency, must be quoted together so that you can be able to trade them. So that you can be able to trade when one is weak and the other one is strong. That's what we trade in forex. So a currency pair is a set of currency that are being quoted or compared against each other. In a currency pair, there is always a base currency and a quote currency. The first currency in the pair is the base currency, and the second currency is the quote currency. So what do we mean by base and quotes? As I told you before, currency appeared, you will have them together. We'll be seeing more of them now. Then we have them together, and the first one by the left is called the base currency. The second one by the left, by the right, is called the quote currency. Let's know more about them. So Euro USD, now we have the Euro by the left and USD by the right. In this example, the Euro is the first in the pair while the USD is the second in the pair. This makes the Euro the base currency and USD the quote currency. In forex trading, all currency are quoted in pair with the base currency strength. The chart price head up. With the base currency weakening, the chart price move up. Let me just explain this. So as we can see in the figure below, you see that whenever you have what is like the euro in our example, when it's strengthening, what you see the market do is go up. Immediately that same euro is weakening, you see the market coming down. So that is how it is. So the opposite is also true. When the cold currency weaken, the chart price head up, and when the cold currency strengthen, the chart price move down. So all of this you'll be getting to know more as you familiarize yourself with forex. These are just the basic. This is currency hierarchy of sorts. When listed, the different currency, they have an order of prominence among other currency. What are we talking about here? Talking about the hierarchy of currency. Those currency have hierarchy, and these are the hierarchy of the currency, the prominence order of currency. So this is how they are being tabulated. So whenever you have euro USD anywhere, you always see it by the left. It's always the base currency because it's higher in hierarchy, and this is how they go down from euro to GB to Great Britain pounds to Australian dollar to New Zealand dollar to United States dollar to Canadian dollar to Swiss francs and Japanese yen. This is how they move. Whenever you see any of this currency in here, you always see the one that is at the top always the base currency. Let's look at some example. When constructing a currency pair, whichever currency is higher on the list will be the one that comes first or be the base currency. For example, when pairing Japanese yen with Canadian dollar, you notice that Canadian dollar is higher on the list than the Japanese yen. So the pair will be constructed as Canadian dollar being on the left, Japanese yen on the right. So that's how you're going to say it. Canadian dollar will be base currency and Japanese yen will be cold currency because Canadian dollar is higher in prominence than Japanese yen. Popular pairs involving the US dollar. These are the popular pairs involving US dollar. We have euro dollar, pound dollar, Australian US dollar. Then we have the New Zealand dollar, US Canadian dollar, then USD Swiss franc, then USD JPY. These are the ones that has to do with US, which people always trade, and these are the ones that doesn't have anything to do with US at all, and people really always trade them. What is PIP? PIP is acronym that stands for percentage in points, and it measures the amount of change in exchange rate for a currency pair. In forex, the major thing everybody is chasing is what we call pips. The more pips you have, the more money you make. The down moment and up moment of the currency pair in the market is what we call pips, and the amount of that pips you make is what is converted to money that you now have. So you do your best to get more of pips in your favor, but we have positive pips and we have negative pips. Positive pips are the pips that comes in your favor. You place a buy and the market moves in up, which is in your direction, then you have positive pips. But when you place a buy and the market now goes down towards sell, then that is negative pips. So everything about forex goes around pips. It is the smallest price change that a given exchange rate can make. There are two types of price quotes in forex. The standard price quotes, currency pair that do not involve yen, have 4 or 5 decimal places, because the pip is all about the movement in this price quotes. We have the yen quotes. Currency pair involving the yen has 2 or 3 decimal places. In forex, you have currency pair that are 4-5 decimal places. They are 4-5 in the sense that some brokers use 4, while some use 5. But majorly now, the brokers we are having now use 5. While yen price code is about 2 and 3. Some brokers still use 2, but the major brokers now use 3. Standard price codes. Those are the ones that is not yen. So all the other currency pair that is not having Japanese yen as pair always have what we call 4 or 5 decimal places. So while those ones that has yen has 2 or 3 decimal places. Then when we look at a currency code, we see cent, percentage of cent, 1/10 of percentage of cent. Let me explain this. This is just so in let's say we have Euro USD now, and this is what the currency value is. So these two is what we call, this is a dollar, and this is 23 cents, and this is 45% of 23 of the cent, and this is 6/10 of a percentage. So this is just the breakdown. You have the $1, the cent, the percentage of cent, then the 10th of the percentage of it. That is what that's how to read it. So majorly the last 6 is not always counted because it's just like 10th of the percentage. So when you're talking about pips now, if the market move from this 1.33456 up to 1.33466, we see the market have moved 1 pip. So what is the value at the back is not always counted. It is the second to the last, which is the 4th one after the decimal place, that is counted at the value. It can either go up or comes down. Yen price code. Yen price code talk about the 2 or 3 decimal places, as you can see on the screen. Then the same thing goes the way we count. We did the other ones. So we have the 82 is the yen, 75% of that yen. Then we have the 10th of that percentage. Then you now have this as not all decimal has cents. That's why, because dollar has cents, then we have euro to euro has euro cents. But pound sterling, we're talking about pence. Then francs talk about wrapping. Then yen doesn't have at all. So that's why you have it in 2 to 3 decimal places. Then because there are several different versions of cent, it has been referred to as the point instead of cent. It would have been percentage in cent, but it's not percentage in point, because there are some other currency that are not cent. So 1 pip is 1/1000 of the whole unit. So I hope you are getting. So now I want to look at, these are just basics. By the time you are getting used to Forex, all of these things is what you're going to get used to. So don't mind if you are not getting full understanding of them now. Very soon you will soon master them. Lot size, leverage, and margin. Let's look into this. The lot size, the leverage, and the margin all work together when it comes down to mathematical formulas. But first, let's take a look at each one separately and learn what they are. Let's look at what is the lot size. Lot size is how you determine what each pip n is worth. When we're talking about lot size, we are talking about the amount, the volume of what you are going into the market with, so that when you now make a pip, what will that translate to you in terms of money? So the amount of lot size you use will determine the amount of money you get from each of the pips that has gone in your favor. So when you place a trade, you have to trade in little currency block or unit. These little blocks are called lots. So when you want to place a trade, you want to place what amount or volume of your money go into trading this, so that the amount of pips you make will now be converted into money in terms of the lot or the amount of volume of your money that you have put into the market to trade the market. A lot is a certain size of currency traded, a certain dollar amount. So the lot of amount, just like the lot of the amount of your money you have that you put into trading at a particular time, which when it goes in your favor, then it will be converted to money and be returned to your account. There are three basic lot sizes. We have the micro lot, which is 1000 worth of currency control. You have the mini lot, 10,000 worth of currency control. You have the standard lot, which is, so this, if you go to a standard lot, which is one lot, then you go into the market with it, then whatever you come out of with in terms of money will be more than what you get when you go with mini lot or micro lot. So that is how it goes. Depending on the volume of the capital you have, that's what determines the amount of lot you use in trading. Leverage. Let's look at leverage. Leverage, now when we talk about leverage, we're talking about what, because the market is huge. What are those things that the broker are giving you to be able to trade the market? You are trading more than the value of your money, because the market moves in so small amount, 1/100 of a cent. We need to magnify the trade size in order to make any real money. Leverage is the trade size multiplier. Leverage is what, maybe you go with $10, you can go with 100 leverage. So when you go with 100 leverage now, you'll be trading as if you have $1,000, and the profit you make will be in that value and not with the $10 that you put. The same thing goes with the loss. If you make a loss, it goes in that value also. That means your broker lend you the additional capital, although no money changes. And what we're talking here is, you have $100 with you. You can be trading as if you have $10,000. So the broker is lending you that money, but it's not that any money is changing. That's what is making Forex profitable, because you go with some certain amount of money and you can trade far more than what you have come with the market with. Let's look at trading sessions. We have different trading sessions. The foreign market is open 24 hours a day, 5 days a week. That is, it open at 5 p.m. Eastern Time on Sunday afternoon as the Asian market opens, and it closes at 5 p.m. Eastern Time on Friday afternoon as the New York closes for business for the week. So you can convert it to the currency of your country. So these are the basic time that the market opens and the market closes. The typical forex trading day has a trading session associated with each major financial center. These are the financial centers. We have the Asia, which is the Tokyo, then UK, London, then US, New York. Each trading session have different characteristics in terms of its most liquid currency pair, trading hours, major players, and market makers. So what we are talking here is, all of this time have their major players. When you have when you are in Asian session, Asian currency will be very active, and players, traders, market maker in that country or in that area will be able to will really move the market for that currency pair. Tokyo session, which is also called Asia session, is between 7 p.m. Eastern Time to 4 p.m. Eastern Time, which is the same thing as 11 p.m. GMT to 8 a.m. GMT. So we have also the London session. These are the major three sessions, which is the Great Britain and Euro which started at 3 a.m. Eastern time to 12 Eastern time, then 7 p.m. So these are the major sessions which is being traded. Then it is important to know that not all hours are necessarily good hours to trade. Trading is best during business hours of at least one of the countries of the currency pair you are trading. So you must locate which currency pair you want to trade. Is it GBP USD? Then ensure that you are in the session between, you are in the London session, or you are in the US session, or you are in the session between. The best session is the session between the London session and the US session, where they intercept, so that you can be able to. But if you want to trade GBP USD and you are now going into the Asian session, you will not be able to see, but there will not be movement of the market. It will be very slow. So that's what we're. So this is the best session to trade, is London session. London session is always very active, because during London session you still have the New York session intercepting it. So people always know there is a lot of movement of the market during the London session. The market can and often does change direction when the New York session begins. The market can still move nicely during this session. Once London closes for the day, the remaining New York session can often be pretty quiet. However, the most volatile part of the day is usually the time when the London and the New York hours of business overlap. So by the time the New York starts, which overlap the London session, the London session is still running when the New York session will start. So at that moment, at that time, there's always a lot of volatility in the market, which really always move the market. So those are the best time you can just stay around to trade. The entire Tokyo session is quite enough that most traders avoid attempting to trade it. The market can move during the Tokyo session, but the movements are limited and often choppy, especially when you are trading the currency pair that are not in the market at that time. If you are trading GBP USD at that time, it will always be choppy. You will not see no decent movement at all. A different trading session will have a different kind of impact on your trading when you start to trade this smaller time frame. Very soon you still know about the time frame. You have the time frame. We have what we call. We start from 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hour. Daily, weekly, monthly. So those are the time frame. But at this time, when you are trading, in different session, the time frame has a lot of impact to your trading style. So when you are the different market session won't influence the 4 hours. So when you are trading 4 hours, which is a lot bigger time frame, the movement in these sessions does not affect you much than when you are trading 5 minutes. When you are trading 5 minutes, the market moves and you catch up with the market. These are majorly traded by those in intra trader. They are the people that just always want to catch up, and the scalping trader, those people you want to catch up some small pips during the day. When you are trading 4 hours, you are not really affected by the movement of this session majorly. Yes, we're going to be talking about this, although this one they are majorly being you get them better even during the when we're talking about the Forex technical analysis, but we'll just be mentioning them briefly here now. Yes, let me just briefly talk about this as I round up this session of this training. We'll be talking about the bid and the ask. When we talk about the bid, what do we mean? Bid is the price at which the trader sells, while ask is the price at which the trader will buy. The ask will always be higher, or during the very good liquidity moment may equal the bid. So the bid is always higher, and the bid and the ask, the difference between them is what we call spread, which the broker always is like the fee of the broker. So the bid is always the time, the price at which a trader sell, while the ask is the price at which he buys. So what do we mean by spread? Bank, brokerage houses and exchange houses charge a fee to change one currency to another. The most common practice for the institution is to make money from the difference between the bid and the ask. So spread is the difference between the bid and the ask. So that is a fee in which the brokerage normally charge. When you place a trade, you always see a negative. That non-negative you first see is what we call the spread, which always first go to the broker before the market now becomes zero and it now start coming to positive. So that is the spread. Then when we talk about stop loss, what do we really mean? Stop loss is very, very vital in Forex. It's always important. You can't just be placing trade and everything will be possible all the time. There will be a time you place a trade and it goes against you. When it goes against you, so that it will not wipe away all your accounts, then you must have a stop loss that when this market goes against me to this extent, let it be cut away, so that I know that I'm stopping my loss at this place, so that I can have more money to trade more and make more profits. So if you have a very good, which we have a lot of them, if you have a very good trading system or trading indicator that are maybe 75%, 80%, 90% accurate, you will still have about 1%, 5%, 10% in which it will have a drop down. If you don't have a good money management, which always work around the stop loss, then that little time can drain away your account. So stop loss is always very, very important. So it helps you to cut short your losses. Then when we talk about take profit, what do we mean? The take profit level is an automated order that will cash in the profits made on the trade at a point price. So you have a time, you have a target you have placed, that when this market moves in my direction towards this place and get to this point, let it just stop and give me that profit. So it's always a good to always set a take profits, so that it will not be that the market has moved and it now come back again opposite what you have placed it and you have not taken the profit. So take profit is a set point in which you have set on your trade, that when it gets to this in my favor, let the trade be stopped and let the profit be taken to my account. That is take profit. Then we have what we call the pending order. What do we mean by pending order? These are the orders you can set on a certain moment in time, but not at the market price. The trade will only be triggered when the market reaches this price. So pending order, you set a time. You are not entering the market straight, but you are setting a time in which when the market moves to that point, the order will be triggered. So until when the market moves to that point, the order will not be triggered. So we have what we call the buy stop, sell stop, then buy limit, sell limit. What do you mean by buy stop? Buy stop are the order you set that is above the price. The buy order you set that is above the price, that when it's going towards buy, which is up, then it will just get to this point and it will move up. So that is buy stop. Buy stop is always above the price, and when market gets there, it moves towards that direction of the market and it goes. While sell stop is always below the price. Then when the market is going towards sell, it pick the sell stop and move down towards sell and give you profits. Then buy limit is always set below the price, but the market is moving up, but you set below the price, so that when the market just move down, draw down a little, it can pick your buy limit and now move up, then sell stop is always above the price. You expect that the market will want to draw up a little, because the market is still going down, but you expected it to go a little up before it start going down. So you set your sell limit at the top of the price. So when it touches it, you just move down to sell, which is in your direction. So these are what we can just we'll be discussing about the forex basis. These are the forex basis you need to know. I'm so sure that by the time you really start practicing, you get used to all of these things. So as I've told us, forex majorly divided into three. We have the forex basis, we have the forex technical analysis, then we have the forex fundamental, which is also called forex news analysis. So we have been able to talk about the forex basis, then and I've briefed you about the forex analysis, forex technical analysis, and also forex forex fundamental analysis. So these are the basics you need to know. And to go further, because we are smart currency trader. We are called smart because we don't go to the market going to gamble. We go to the market with tools. We go to the market with forex gadgets, software, indicators, robots that we have tested and seen that they are working well. So we trade the market with. So if you are just starting and you have learned the basis of forex, then you can arm yourself with this tool, and this tool will just guide you. Most of them will tell you buy, stop. Most of them will tell you buy, sell. So give you instruction and you follow it, and you trade like a pro, even when you have not really been able to, you have not mastered any trading skill. Those are this, they have put a lot of effort and skill together to make all these tools. So if you need these tools, you can always get across to us so that you can be able to trade smart. So I remain Jide Adilo from Smart Currency Traders. Thank you.